Good evening, everybody. Welcome to the Stock Market Brief Show. I got some really interesting data to share with you. There's been a lot of talk about bifurcation in the markets, about bad breath. We've been kind of talking about that as the market continues to press higher. But today I want to show you some very interesting charts, and it made me do some research based off of this tweet here by Jason. And what he had stated was that he'd listed the dates, right, every time in the past 30 years that the Nasdaq closed at a 3-year high for 7 days in a row, which is obviously fairly rare to occur. As you can see, these are the instances of the last 30 years. But it also, you can see these sevens by it, it also shows the number of days there were more stocks at new highs than lows during the streak. So looking at breadth, right? New highs, new lows. And basically what he was pointing out here was every one of these 7 days, right, in a row that went up in a row that closed at 3 years highs, what do you see? Well, they all had positive breadth, right? New highs outweighed the new lows, 7 days there. And then the difference here is in June 18th. But this made me kind of want to dig a little bit deeper to see if there was any instances that we may have seen breadth maybe leading poorly into a market pullback, correction, or so forth. So if I show you this, this is the Nasdaq composite up top, and these are the Nasdaq new highs versus new lows. So basically what he was doing was on these dates here from 1996 down to 2024, I went ahead and showed you briefly where the streak was, okay, where the streak was going into 2000. And what you'll notice here, you'll see the streaks of new highs, right? So when it's red, that means there was more new lows than new highs. And you can see that he was just basically pointing out, while we had that positive breadth, there was actually new highs. And we all know what happened after the dot-com bust, but shortly after, but the market did rip a lot higher. So we'll get into that. And if you continue on in 2015, you see this little rip here, those 7 days, all new highs versus new lows. They were positive, more new highs versus new lows, positive, more new highs versus new lows, right there is positive. It wasn't until you really come here, which is the current chart of the Nasdaq composite, where you can see we had 1, 2, 3, 4, 5, 6, 7 days in a row, minus obviously today. And you can see 1, 2, 3, 4, 5, 6, 7, minus today and minus this other day here. There, you're seeing a lot more red, obviously, versus, which means you have more new lows than new highs. So what he was pointing out was we had one day, and every other time, right, led to longer stock rallies, right? And it was positive breadth. So I wanted to dig a little bit deeper and use a different indicator. And instead of new highs, new lows, I wanted to use the Nasdaq McClellan Oscillator. So if we go back, I can't go back with the Nasdaq McClellan Oscillator all the way to 96, 97. So I went back as far as I could, which I believe brought us to 1998. Yes, so 1998. And what I wanted to call out here was you can see also that the Nasdaq McClellan Oscillator was positive, but what you noticed taking place was you did see some bearish divergences here as they were forming, and it led to a market sell-off. But needless to say, we did have positive Nasdaq McClellan Oscillator reading, so the internals were strong, albeit that divergence that built. If you continue on and you go to 1999, this is in January of 1999, you see the rally, you see the Nasdaq McClellan Oscillator had positive breadth, and we had a subtle divergence that did lead to a little bit of sell side. Now, if we scope that out and we go to the next date that he had listed, was right there leading into 2000, and this is what I found interesting. So during this time for the new high, new lows, we had more new highs than new lows, so we had positive breadth there. But the Nasdaq McClellan Oscillator, as we were going into the 2000, we actually had a nice rally, but we did not have any supportive breadth there that followed. And what happened shortly thereafter? Well, shortly thereafter, we started to see much more market turbulence, right? So going into February of 2000, so for a few months there, we saw some violent swings to the downside, upside, back to the downside, and then we rallied to find a peak in the dot-com bubble that popped right there. And during that time, we also noticed the negative divergence in the Nasdaq McClellan Oscillator too leading into that. Now, if I continue on and look at the other dates, you can see the Nasdaq composite, the Nasdaq McClellan Oscillator. You see it's in black, right? That's positive. You saw the divergence, and we saw some turbulence there playing it out a little bit to the downside or digesting. We'll continue on and look into 2017. You can see, wow, we had that rally there as well. Positive McClellan Oscillator readings there too as well. If you go into February of 2020, right? One of the other days he listed, as we get that rally that's highlighted right here, we had positive Nasdaq McClellan Oscillator reading there too as well. Okay, now take it to January 28th of 2022, which you'll see here is we had the positive rally right here. And what did we have? Well, we had positive market breadth. It wasn't until later that we started to see negative market breadth going into 2022, which happened to be the bear market. So I wanted to zoom in now and kind of show you what I found interesting, and that is looking at the Nasdaq composite where it stands now. You have this rally, right, of 7 days, and the entire rally actually has been in negative territory on the Nasdaq McClellan Oscillator reading. Now, this is interesting to me because the only time that this is comparable to according to this tweet, right? So according to this tweet right here, right, we've had less new highs and new lows, but the only time that we've had negative reading of the Nasdaq McClellan Oscillator on positive move like this was going into the .com bubble bursting. So you can see all negative, but I wanted to just kind of point out here, even though it was negative, we ran into market turbulence, but the market rallied significantly higher from that point. And this is what I find interesting is there's a couple other things that have been taking place during around the same similar period in time. And that is that NVIDIA recently took out the market cap of Microsoft to become the #1 company by market cap in the S&P 500, if not the world. So I took a screenshot there when it happened. And if you go back to 2000, it was March of 2000, Cisco Systems was actually briefly topping Microsoft as the most valuable company there in the world. And I found it just to be interesting that Cisco, it's not like a household name. And in my opinion, neither is NVIDIA. And how I kind of determine that is if you go to like your parents or your grandparents or something like that and you say, hey, what is NVIDIA? The chances are very few of them will know what NVIDIA is, what they do. Some people know that they have graphics cards in their computer, maybe. But chances are they'll really know Microsoft, they'll know Apple because those are household names. So does this mean that we're going to have a similar type reaction in the markets? I don't know, maybe, perhaps. But if it is anything like 2000, that means we can potentially go through a period of digestion, which this can very well lead to a period of digestion. And if it's like 2000, we can still rally a lot higher. And then we could start to look for negative divergences continue to form. Now, the big difference between here, the Nasdaq McClellan Oscillator and the new highs, new lows is we have one, less new highs versus new lows, right? We got that one reading. And on top of that, we have bad breath in the Nasdaq McClellan Oscillator reading too as well. So if you're wondering why bad breath, why does it matter what's it matter that few stocks lead the market higher because we've been beating this down? Well, there's other charts I can show you too that you can find these subtle divergences that take place and they can lead to sell side activity in the market, which we have seen in the past and we have yet to see right now, but it becomes very obvious if something were to happen. So for example, if I go to way back when, this is looking at going into the .com bubble, you can look at something like Dow Jones Industrial Average and compare it to the New York Stock Exchange. I was going to use IWM, but I didn't go back this far, so I just used NYA here. But what you'll notice here too is you'll see that it puts in lower highs. At the same time, you have the Dow Jones Industrial Average going through periods where it puts in higher highs, and you have these subtle divergences that gave us insight that the internals were weakening in the overall, the bigger market here, and led us to some sell side activity. And then you can even go to like the great financial crisis, right, where we had a higher high there in the Dow Jones Industrials, and IWM put in a lower high. And all right, there's a reason why I'm showing you IWM. If we can even go back in more recent years, going into the pandemic, right? IWM put in a lower high on the weekly time frame. Dow Jones Industrials put in a higher high. Same over here, right? You can see that the Dow Jones Industrial Average put in matching highs. Meanwhile, we had a much significant lower high in IWM. It has positive divergences too, where the Dow Jones went lower, IWM put in higher, and that led to a nice rally there. And then if you look recently, right now, the Dow Jones Industrial Average and IWM, you can see that we're putting in a higher high in the Dow Jones, and it led to a little bit of a sell-off, right? We don't know if it's going to recover, recoup, whatever the case may be, but you have the IWM also continuing to show weakness and diverge from these bigger markets like the S&P 500 and the Qs. I want to show you this chart too. This is the Nasdaq record high percent index. And you might be wondering, okay, if we sell off, where can a bottom be? Well, if you date back into the 90s, you'll notice that when we get a reading over here, this is the 10-period EMA of the Nasdaq record high percent index. When we get it smashed below the 20 reading and it turns back up above 35, it's marked pretty significant bottoms and times for rallies in the market. So notably, right, if you look over here, going into 1999, right here, it dipped. And this is pretty much towards the end of the bubble bursting there, the dot-com, the great financial crisis, right? There was a hiccup right here where it crossed above very briefly and then started crossing right back down again. So that's something to note. Over here in 2011, going into 2012, where we had quite a bit of turbulence there, led to a nice move from that market bottom. Even in 2016, even the pandemic, and then more recently, the 2022 bear market bottom, you can see that we crossed down through the 20 reading and we did cross back above through it right here. And then in a recent trade, very recent trade in 2023 going into 2024, where we had that 10% correction, it got oversold incredibly quickly and then turned back up, and it led to a significant rally there in the Nasdaq composite. So we're still at a very positive reading right here, albeit though we had a high, lower high, we had a high and a higher high there. So if we do start selling off, I would imagine that the sell-off could happen, aggressive or not, I don't know, but the oversold conditions could probably happen very quickly. And that could lead to let us look back at this chart when the time is right to give us insight to potentially when breadth comes back into the market to find some sort of a market bottom, if that is going to be the case. Hope today's episode helped out everybody. I just wanted to show you just some interesting data on market breadth, and I just wanted to dig a little bit deeper into this specific tweet there by Jason. Hope it helps out. See you later.